One thing we have seen in December is that small and mid caps have begun outperforming large caps. So we're seeing broadening in markets. Even yesterday with the pullback, we saw a record number of companies getting above their 50-day moving average. So that broadening is good, but it can be worrisome in the sense that it often marks the end of a major cycle when you see too much broadening. Now, December historically is marked by small caps and mid caps outperforming. But next year, if the rally is to sustain, we do want to see the strength come back into large caps. The other thing we don't want to see, especially with a new Fed chair coming in, is aggressive and fast rate cuts. Those usually signal panic. And if we look at the previous periods where the Fed pivoted and began cutting rates aggressively, you can see that those were met by sharp drawdowns. And our last two instances here were the dot-com bubble and the GFC and then COVID. But for a sustained rally and to avoid a sharp pullback, we want to see the Fed begin or continue to cut, but in a staggered, steady fashion as opposed to something sharp and aggressive. And if we do see sharp and aggressive step in, that signals panic and signals that we should get more defensive with our positioning.